being willing to be interviewed through this.
Thanks, Nigel, and yep, happy to be here, and thanks for joining us.
Fantastic. And so for the arch clients, you might not have met Brigitte yet. She's joined the team fairly recently. She's actually based in Canberra. Obviously comes up to the Sydney office. It's been really exciting to have her on board with the team. For those who are attending who don't know me, I'm Nigel Baker. I've started Arch Capital 12 years ago. Your advisor, if you don't know me, is obviously Brigitte, and she's probably explained how we all work together. But yeah, so let's get into it. Along the way, we will ask for questions. There's plenty of time at the end to ask questions. So reach out. There is a little raise your hand, but don't be afraid just to take it if you can. If you're not muted, just ask a question as we go through. And Amy, if you could hit record on this as well, because so we can share it. All right. Okay, so agenda today, end of financial year tax strategies is the focus. We're going to look at the key super strategies, look at some of the tax things to think about before 30 June, really look at that importance of year-end planning and making sure you're up to date with what's going on and what you need to do, maximise some of those tax benefits that are available to you. Obviously, ensure compliance with the tax laws. Everything we do obviously is within the rules, and there's at the end of it, I've got a few slides which I'll talk about cybersecurity as well, and some of the things obviously going on out there, what to be aware of, all the policies, procedures, and protection we've got in place and the providers got in place to give people some comfort, but also some things of what to really watch out for as there's some pretty sophisticated operators out there trying to get amongst people's emails and text messages and the like. All right, so we'll jump into super strategies. As I said, we're going to run this as a bit of an interview sort of style to Brigitte. So Brigitte, there's lots of content here. Today's purpose isn't just to read through the slides, but really what we want to focus on for 30 June is, what are the different, just a recap on some of the contribution types, what you can do, and how much you can contribute before the end of the year. So do you want to just explain a little bit about, to start off with, what the different types are, because people always get confused, what's concessional, non-concessional, all this jargon that goes on. Yeah.
Yep, absolutely. So I guess, to keep it simple, really, two types of contributions that we see out there. The concessional, we can think about anything that's sort of pre-tax or tax-effective contributions. So that's that current cap is at $27,500. It is going up to $30,000 come 1st of July. So that's a bit of an indexation right there. When we think about concessional contribution, so that's really typical superannuation guarantee. So any SG contributions that your employer is paying, any personally deductible contributions, so any contribution that we put in there in our super fund and then claim a tax deduction for. And then also any salary sacrificing. So if you have an arrangement with your employer, putting pre-tax money in that all falls in that concessional contribution. Non-concessional contributions are any sort of money that we contribute to super from after-tax money. So that the current cap is $110,000 a year. And there's also provisions depending on the different thresholds that we've got in terms of the total super balance, whether to bring forward the next 2 or 3 years worth of contribution. But I guess instead of just throwing numbers at you, what are the different things that we see and we've been doing actively with our clients? Probably in terms of what we call catch-up contributions. So what that is if our client's total superannuation balance is under $500,000, the rules allow essentially to carry it forward or essentially use any unused concessional contributions from previous financial years up to a rolling 5-year and essentially put additional money into superannuation to help boost retirement savings. So that is something we've been working a fair bit with clients just to be tax effective at the same time, but also grow superannuation assets for retirement.
That's just on that one, Brigitte. A lot of people sort of probably haven't really heard about this one. So you've got to have $500,000 so just check on the dates. And if you do put in those contributions, are they still tax deductible and do you still pay contributions tax?
Yeah, absolutely. So that $500,000, that is as at the 30th of June of the previous financial year. So that is very important, obviously, to check. And then when those contributions are going into superannuation, it is really important to be able to claim a tax deduction for those contributions, to still submit that notice of intent to claim form, which then will essentially say we intend to claim a tax deduction for it. That also means when those contributions are going into the super fund, so any concessional contributions are effectively taxed at 15% going into the fund, but then we get that tax deduction in our name. So the real idea is, instead of having those tax and marginal tax rates, essentially bringing down the taxable income in that sense.
Right. So someone with obviously a higher taxable income, that could be maybe from a capital gain, for example, that could really be beneficial. Yeah.
Yeah, and that's really what we've seen. A couple of clients who've sold investment properties during the financial year, triggered a capital gain, so end up with a higher taxable income. And if there was that room to essentially use some of those unused concessional contributions, a really effective way of essentially potentially even cancelling out entirely any capital gains from that investment property.
Yeah, fantastic. Interesting. All right, thanks for explaining that. And also just a recap on the concessional contribution, which is your tax deductible contribution. If your employer, is only putting in 15,000 or 20,000 or 5,000, you're allowed to personally top that up and claim a deduction? Yeah,
absolutely. So concessional contributions, caps 27,500, whatever essentially your employer puts in there, to make it simple, $20,000, there's still that $7,500 room left to make a personal and deductible contribution into that super fund before 30 of June.
Fantastic. All right, so that sort of talks about some of the contributions, and then there's a few things that talk, again, not as commonly used and maybe not as well promoted, about how you can split your super and make a spouse contribution. How do those contributions work?
Yeah, so we've seen this strategy being used a fair bit with clients where there's one of the spouses on the lower taxable income. So essentially, it could be a tax effective way of growing the lower income spouse's super account in a sense. Current laws, I guess, to benefit from, I guess, the maximum tax offset that's available out there is as long as the spouse has taxable income of under 37,000 a year, if the contributing spouse puts in or contribute into their spouse account, $3,000. So obviously that boosts the super for the spouse, but the contributing spouse also receives a tax offset in their name. So it's a bit of a win-win situation, growing the low income spouse's super balance, and then getting a tax offset in that. So that is the spouse contribution. Contribution splitting is a different type of strategy where we look at evening out or balancing super savings. Essentially, contribution splitting allows a spouse to split essentially up to 85% of their concessional contributions. So that is everything that's, again, the superannuation guarantee, personal and deductible contributions, and salary sacrificing, and to split 85% of that into, again, a lower balance spouse's account. So that is a strategy that can be quite useful to, again, try to increase the lower balance spouse super and essentially have as much as we can between the spouses within that tax effective superannuation environment.
Fantastic. So, often we do see balances are uneven, and with the caps now, because you can only have a certain amount of super tax free, that could be really something for people to look at in terms of building up to the balances together. So in essence, I put in $10,000, the contribution tax comes out, I can split the 85%. That's how the 85% comes around. 8,500 then gets moved. Now, if I'm in a public offer fund, they'll do that somehow, but in a self-managed super fund, they just allocate that back into my spouse's account.
Yep, exactly. That's exactly it. Well, there's essentially a form with most of these contributions. There's always some form from the ATO, and with ourselves or in your account, and we can certainly help with that along the line.
Great. Yeah, that's a good one. And another big one that we've been talking about a lot the last couple of years, with a lot of people selling houses and downsizing, so to speak. But there's now a way you can get quite a considerable amount of money into super from this downsizer, which is in addition to the non-concessional contribution. So you've got the $110,000 a year tax free, but on top of that, you can put money in from the sale of the house. So do Do you want to just explain how that works and some of the key rules around that?
Yeah, so I guess downsizing contributions, it's a bit of a special type of contribution out there, in a sense that also, and we'll cover it later, but there's also no age limit on that downsizing contribution. I mean, upper age limit, there's a minimum to be eligible, so you have to be at least 55, and essentially use the sale proceeds of a main residence that you've lived in there for at least 10 years. That also qualifies for that main residence exemption from an ATO point of view. And essentially, this is a really great way of, again, when someone's downsizing, to boost super balances, because the current rules allow essentially to contribute up to $300,000 or the sale proceeds per person into superannuation. So hypothetically, between a couple, it's essentially 300,000 each that can go into superannuation from that downsizing contribution.
That's not bad. So you get to sell your house tax free because it's your primary place of residence, and you get to put in 600,000 tax free into super on top of the potentially 20,000 you can put in tax free already next year.
Yep. So it's really, we can see a lot of contributions. It could be quite an effective way to get the timing right as well, but also the order of things. So yeah, absolutely, yeah.
Yeah, fantastic. All right, I think we've covered off those. Anything we've missed there in terms of year end? So really make sure you look at your contributions cap. If you can put more money in, it makes sense. The tax deductible. Obviously, if there's excess money around, you've got to make that decision between, do I keep the money outside of super or do I put it into super, thinking about when you can access your money, which we'll talk about in a minute as well.
Exactly.
Great. All right, so yeah, talking about some of these age limits, it gets a bit confusing. So you just said with the downsizer, you could be 100 and put money into super. So that's a bit bizarre because yeah, some of these other contribution limits are quite restrictive. So yeah, give a summary about some of the key age limits around when you can get money into super and when you can make when you can make contributions.
Absolutely. So I guess the super guarantee contribution, so what we receive or what the employer essentially pays into a superannuation. So there's no upper or maximum age limit, essentially, as long as we're working. Superannuation guarantee contribution can be received. Non-concessional contributions, so those were those after tax or the $110,000, probably for the most common ones, contributions. So there is an age limit on that, which is 75. So up until someone turns 75, and there's still a little bit of window past that. But essentially, 75 is the upper limit to be eligible to make those after-tax contributions to superannuation.
And now I can do those without having to work as well, yeah?
Yep. So that was a bit of a change since 1st of July 22. Essentially, the money can be contributed to super without having to meet a work test. When the work test comes in, that's when we actually want to claim. So we put the money into superannuation. And if someone's between age 67 and 74, or 75 essentially, we really need to make sure that to be able to claim a tax deduction for those personally made contributions, so convert an after-tax contribution into a personally deductible one, we need to meet a work test. So the work test essentially just means we need to be gainfully employed for at least 40 hours within a 30-day period. But essentially, the rules have been relaxed in a sense. We've got that window of opportunity now to put more money into superannuation and also be able to do that for longer, mostly up until 75. And then, what we mentioned, downsizer contributions. So there's no maximum age limit, but there's that minimum age of 55 to be eligible.
Yeah, great. Obviously, there's a few dates flying around there, so that's when people do need some advice around if they are making contributions of the different types and just checking that it's all possible.
Exactly.
And that ties into withdrawing money. So again, another set of rules, and they don't all line up exactly with the contribution rules. So yeah, just again a quick recap on there's this word that comes around called preservation. The age there has been changing a little bit. People get a bit confused about when they can access money. Can they access money when they're younger? Do they have to wait till they're 65, 67 because that can be the pension age, or is it 60? So and also there's a lot of people with defined benefits, particularly in Canberra as well, but it's not just in Canberra. So yeah, how does it work? When can you get your money out of super, and clarify some of the confusion around some of these ages? Yeah.
Yeah, absolutely. So certainly accessing super we get a lot of questions about clients as well. But as a rule of thumb, so obviously superannuation assets are what we call preserved until we essentially meet a condition of release. So for most people, that would be retiring, reaching preservation age, and retiring. So that's probably the most common condition of release, or in other words, being able to access superannuation assets. So up until, I guess now, preservation age was a bit anywhere between 55 and 60, depending on when someone was born. Come 1st of July this year, it does make it a bit easier because everyone's preservation age will be 60 going forward. But what that really means is, again, I think work really getting advice in terms of where you're sort of sitting and what are the different conditions that you're meeting. So turning 60 essentially is sort of a magical number in a sense that the rules around accessing super are less strict. So if someone's under 60 and is looking to withdraw money from superannuation, we really need to meet a condition essentially saying that we're permanently retiring from the workforce and never intending to go back essentially in gainful employment. So there's a bit of a harsher condition than when someone's actually ticking over that 60. The conditions are a bit less strict, and it's really about then changing or ceasing a gainful employment. And that could essentially, for example, if you think of a client who has let's say two part-time jobs, ceasing one of them but continuing completely the other employment relationship, that will essentially tick the box if they were to do that once they turn 60. And then I guess turning 65 is the ultimate number when it comes to superannuation at the moment, because it's what we call, we have unrestricted access essentially to superannuation. So turning 65, you don't need to retire. You can keep working, don't need to cease employment, but can also essentially turn on that account-based pension up to different limits. I guess, Nigel, you mentioned that defined benefit. So certainly something I've been working quite a lot with clients here in Canberra, but they're certainly around Australia as well. And it's really defined benefit. So when we think about PSS or CSS, just to name a few, they have their own different rules. As a rule of thumb, clients can access funds from when they turn 55, but it's the same sort of similar preservation rules apply. So it's that hard ceasing employment if you're looking at claiming at 55, or essentially changing employment arrangement from 60.
Excellent. Fantastic, Brigitte. Obviously, yeah, we'll get to it as well, but withdrawing money and people taking pensions this time of year, it's a real reminder. Balances have gone up. The last year, people's minimums have increased since the COVID period. So a lot of people are starting to realise they've got to take a bit more money out than they probably realise. So we'll be sending reminders around, but it is a reminder for everyone just to check their withdrawals, reach out if they're unsure. When they get their accounts, they are told what the minimum is, but we'll certainly be reminding everyone in the next couple of weeks in case they haven't calculated that properly. Yeah. Great. Okay. Yeah, so on to that. Yeah, pension minimums. Again, there's sometimes a lot of questions around this: how to take it out, when to take it out, how long, what are the rules if they miss, which we don't want people to miss. So hopefully they don't miss out the minimum, and how it increases. So again, people get how much they have to take every year. So again, over to you, Brigitte, just to explain how this works and some of the best tips around meeting the minimum requirements.
Yeah, absolutely. So pension minimums, that was, as you mentioned, Nigel, sometimes gets a few people, because how do we actually calculate it, and what does that minimum withdrawal percentage mean? So essentially, once we turn on an account-based pension, the government says we have to draw a minimum percentage out of that balance, which is based on essentially how old you are, and also what is the balance in that account, either at the time of starting for the first time that pension, and that or 30 of June each year, essentially for subsequent years. So again, let's just take as an example, but if someone's under 65, they've retired or changed employment once over 60, they're eligible to turn on an account-based pension. Their minimum pension withdrawal for the year is essentially 4% of whatever balance is used to start that pension. So that is really the minimum withdrawal. It doesn't mean that you can't take more out of that pension account, but that is the bare minimum that everyone will have to meet to be compliant with the superannuation rules each financial year. I guess what we encourage clients to do, and you might remember during COVID, these minimum percentages that you can see on the screen have actually halved. Now we're back to what we call the standard minimum withdrawal rates. So, just to make sure we manage that, I guess, throughout the financial year, taking pensions monthly is a good idea, but we still need to see clients, sort of have the flexibility there, whether we take it quarterly, and some clients even decide to just sort of take it on a yearly basis.
Excellent. Fantastic. All right. So again, we're not, even though we talk a lot about tax, we obviously recommend that people talk very closely with their accountant, and we try to coordinate that relationship as best as possible. But when we're talking about individuals end of year, we do get a lot of questions, obviously, as being the key advisor. The general principle of tax deductions is obviously it's got to relate to your assessable income. There's lots of rules around it. But often it's a bit of a common sense approach as well. So we often get questions that obviously don't make sense, and people understand that. But a lot of the questions come around some of the basic things they can do, and if they have got investment properties. Again, so the purpose of today isn't to be, saying here's a list of everything you can claim, but just again, some of the key questions we get and some of the key themes that we see. If you want to just touch on that, Brigitte.
Yeah, absolutely. And I think obviously there's a couple of examples there, but as you mentioned, Nigel, I think it's obviously talk to your accountant, and we're here as well to help. But the key thing is that connection to that income. So whatever it's an investment property or claiming, work-related expenses, there needs to be a connection between, I guess, our taxable income or earnings capacity and earning that income and the actual deduction that we intend to claim. So that's just, I guess, one of the examples. We see donations as well to charity being one of the examples that may be tax deductible. I guess with all these different examples up there, the key thing is, and that we certainly encourage clients, is to have really good record keeping and documentation, because that will really help your accountant as well at tax time. Just make their life easier, and certainly your life as well, instead of having to go through boxes worth of invoices and things like that. Is just keep regularly track of all those different expenses and things like that. So there's tools and apps out there for managing receipts and all that. One of them being the My Deductions app from the ATO. So just small little things that can help tax time become less painful.
Yeah, absolutely. Like a lot of this stuff now is electronic. People keep it on a file. But we still do see people with paper receipts and things like that. So ideally, scan it all in, have it in a nice electronic file, and that makes it nice and easy. And you can easily just share that with the accountant. The tax office obviously picked up most things, but your donations, your property claims, and all those sort of things, really got to keep clean records so you can get the most out of it.
Yep, absolutely.
All right, so a few changes. Nothing, obviously we had a budget one a few weeks ago and there was nothing much to talk about, but there are some changes though that have been in place for a while now that are coming through. A quick one is on the tax rates, and also the super guarantee going up as well, which isn't in here, but if you want to just touch on those changes, yeah.
Yeah, so I guess a couple of changes coming up for come 1st of July is the amended stage 3 tax cuts. So just included the sort of summary of the changes there, but essentially it's really sort of the first, essentially the 19%, I guess, at the moment after the tax-free threshold is going to reduce to 16%. So and essentially broadening the base where essentially now the marginal tax rate will be 30%. So that will kick in 1st of July. So what we might see is, depending on obviously your personal circumstances, your after-tax pay on a fortnightly or payroll basis essentially might go up. So you might end up with something a little bit more each month. But that's, so we've got the stage 3 tax that's coming up. Changes in contribution caps. So as I mentioned, concessional contributions are going up to $30,000 a year come 1st of July, and then obviously the non-concessional cap is always determined as 4 times the concessional cap, so that will essentially go up from $110,000 to $120,000 as well. So again, that opportunity there to just check in, make sure things are still appropriate. I guess for salary sacrificing arrangements, so if there's an arrangement with your employer in place, just certainly worth reaching out to ourselves as well to make sure that with the changes in caps, and I guess the other thing that we could probably add here as well, we've got the superannuation guarantee going up to 11.5%. So make sure that we all adjust, sort of that we're not breaching any caps.
Yeah, fantastic. Yeah, 11.5%. So it's getting up there, right? All right, so I thought we'd just pause there. Just if there's any questions. Obviously, thanks so much, Brigitte. Really appreciate your technical knowledge there. We've covered a lot there. We've sort of kept it pretty high level as well. So opportunity, if there are any questions around what to do before 30 June in terms of contributions, we will be sending out some reminders for clients, particularly around pension minimums and contributions, just to recap, or if there's anything else around tax time. Still a month to go, but as we all know, it comes around pretty quickly. So really the next couple of weeks are key to organise anything. So yeah, any questions? Yep, there's one there. John, do you have a question? Are you on?
Yeah, I just in terms of the calculation of the minimum withdrawal amount, it's, in my instance, it's 4% of the balance when taking out the pension. However, I also have a defined benefits component to my pension. Yes. So is that 4% calculated on the total balance transfer cap at the time the pension was taken out, or is it calculated on the balance transfer cap less the defined benefits pension? So in other words, only the pension, the account-based pension, I should say.
Yeah, it's a good question, John. Like, so when you've got a defined benefit and another pension, can you hear that? They sort of work separately. Like, so the default, what you're taking out from the defined benefit, unfortunately, doesn't count towards that. So whatever your pension balance is, you've got to take the 4% on that pension balance, which is the outside of the defined benefit amount, if that makes sense. Hope you're going back on mute, sorry. How do I get you back off then?
4% of the account-based pension. Is that what you're saying?
Yes, yeah, that's right. Yeah.
Right. Okay, thank you.
Yep, thanks for the question. Anyone else? All right, so I was going to thanks so much. So just to wrap up a few slides here on safety online. So the key point of this is to make people aware, particularly themselves, family members, older parents. We're seeing people are getting caught up with things. We haven't had any experiences here, but we are hearing stories of people's older parents perhaps replying to an email or taking one of these phone calls and getting police them some money. You got to be so careful. So from an investor protection point of view, what we want to do is make sure that people understand the systems in place, the protection in place, some of the training and policies and procedures and insurances and things that are in place in our business and in the industry we work in, but also just to remind people of not what to do. So, we're not going to, if there's something that looks strange, we always say, take caution, call up. If you see an email that just doesn't look like it's the usual way we would communicate, if it's the usual way if it's Macquarie Bank or whatever would communicate, just do call us. That's the safest way to avoid anything. On the same side here, if we ever see something that just doesn't look like a normal client email, we will call. We've got policies in place to not obviously action something if it just doesn't look right, and to confirm anything that's out of sequence on a phone call as well. Same with the information, obviously having secure files these days, limiting what we share on email. As much as we've got protections in place and systems in place, and the best we can possibly do, we know there's a really sophisticated hackers out there around the world who are trying to get information from all sorts of systems, and we're constantly updating that and our with our IT systems and protection in place and the like. So a big thing of those, that awareness, just being really aware that things can get in between. Apparently now even text messages they can intercept. So when the bank send you those text messages with a code, the bank's now about to change all that and go back to an app because people have been able to intercept those codes somehow. And so we're obviously trying to stay ahead of it and keep everything safe. One of the things is we can't transfer as a licensee. We never hold people's money, and we can't transfer to a bank account that's not in a client's name unless you've signed all the forms and that's been verified by Macquarie Bank or whatever anyway. So there's one safety thing there. We've got policies in place and really strict processes around all this, obviously with our IT providers, our licensing, and how we've got insurance policies in place. If worst case somehow someone did hack into the system, we've got cover. Hope that never happens, but we've got to have that these days. Everything's two-factor. No one can log into any of the systems here and transfer money to anyone's random account or anything like that. And the way the sort of the money is saved. So I was going to run through how the sort of industry works. There's a bit of a map here and a bit of information, but I just wanted to run through where the money sort of flows. So it's a bit small perhaps, but there's a whole system of how when money flows between the systems we use and the banks and the fund managers, how that's protected, and how the industry itself, there's lots and lots of regulation and systems to protect all that. And the custodial system really is what protects. So there's two things about the custodial system. It's so the end fund managers actually aren't holding the money over. So from a risk protection point of view, if someone's fraudulent in Macquarie Bank or something like that, they've got lots of protection around that, obviously, or the fund managers, and how that money flows through is all very regulated and highly governed by obviously the laws, but also there's this custody system that basically applies. So it's not like your investments are sitting in just a little Excel spreadsheet. There's a lot of systems behind the scenes that keep it all as safe and secure as possible. And there's a slide here about how sort of the custodian works. And for a lot of people, obviously it's an industry thing, but there's basically a big bank, which is in this case Citibank, actually acts as the custodian. And that money flows between the fund manager and the custodian. Basically, the fund manager has a trust account that they can trade on, but they actually don't hold the money in their bank account. So if the Vanguard, which is a $12 trillion business, for some reason went broke, they actually don't hold your money anyway. So the custodian holds it, and then APRA would come in and appoint a responsible manager to take over the management of that money. So it's very, 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 almost impossible for that money to be at risk in the systems we use. But the biggest risk really is between the emails and things like that. So the systems behind the scenes are really secure and strong, highly regulated, but now it's really being aware of what can be caught out on an email. So we might email out and someone might email back their bank account, for example, or those things you just can't do anymore. You've got to put it into secure files. You've got to call up and confirm bank accounts, things like that. Even on invoices, you've got to check that someone hasn't intercepted it, changed the bank account. So there's a lot of things like that, which really where emails becoming quite insecure, because it's not about behind the scenes systems are good, but it's how someone can get in there and open up a file because of an email or an email attachment. So I think what we'll see going forward is that there'll be very few attachments going around, and people will be using just secure files and using sort of two-factor logins. We do get a bit of feedback that sometimes, like Macquarie Bank, for example, is a bit pedantic about all that, but that's a safety thing. So when people are trying to transfer money, they might get a call and might get a second authorization. The signatures now and anything that's got to be authorized, often they'll go back and forth a few times and not happy with signatures. They want to check it. So that's to protect people's money. We think that's really important. Obviously, can slow down the application process, or if someone else wants to transfer money. But we think that's a good thing, because it does make sure that not only us, but the banks and the fund managers are all very vigilant and really trying to avoid anything going wrong. So again, the biggest thing is to be aware. If there's something strange, if you get a text message from us or you get a text message from anyone that doesn't look strange, just call, and we do the opposite. So I've only had it once where I've got a strange email from a client, just didn't look like their language. They said they were in a panic and needed some money transferred. We called them. They happened to be in Japan. I woke them up, but they were thankful for the call, saying that certainly wasn't them emailing me. So thanks for the alert, and someone had hacked into their email. Now, we couldn't have done it anyway, but it just didn't look like them. So we would have had to call anyway and say, well, we need to set up these forms for you to transfer this money. Any questions or concerns around that, or I have skipped over that. There's a lot of information around how that sort of system works behind the scenes, which we're happy to share. But again, Australia's got, has got a pretty good process and system, and that's why we use a lot of these systems behind the scenes as well. We don't just sort of go direct to, you do unfortunately hear people losing money in the industry. They tend to go direct to some wholesale investment. They don't use all these custody systems. They suddenly go broke because it's wholesale. They're not protected, and bang, it's gone. So that's why we avoid a lot of those sort of direct and those type of things. Any questions there? So we're constantly working on it. We're constantly reviewing policies and procedures. As I said, there's the IT team we're working on, constantly updating what we need to do and what's best practice, and we're putting in place the best we can possibly do at any point in time. All right, so again, probably have opened up for questions now. If there's anything else, obviously it pops up, please reach out. We will share these slides, and there's been a lot of people who've asked just for the slides. They couldn't attend at this exact time. Again, thank you so much. If there's anything personal, reach out to me or the team. And Brigitte, again, thanks so much for your content and talking today. Of course, the disclaimer, we have to talk about any information today. It can only be general information. If you want us to talk about your personal situation, that's what we're here for. So the slide deck is just general in nature. Anything else?
Thanks, Nigel. Thank you very much.
Thank you, John. Thanks for attending. Thanks everyone for attending. Hope it was helpful.
Cheers. Bye-bye.
Well, thanks very much. That was helpful.
Thank you.
Thanks for attending.
Thanks for attending, everyone. Okay. Anyone else still on?